A lot of earnings are coming in. Globally, stuff is happening. Global markets are outperforming India. So let's discuss all of that with Karthik Kumar, who's joining us today from Axis Mutual Fund. He looks at the alternative business at Axis. Karthik, afternoon. Thank you so much for your time. Before
Thanks
even,
for having me.
this group of stocks coming under pressure hit the market as a worry, there was another there was another worry we had to contend with, which was that we had rallied quite a lot, and now the world is catching up. How long do you see this adjustment will continue to happen, and because of which India could remain sideways with a negative bias? Because we are seeing very good amount of outflows from India going into Taiwan, China, all of that. How do you analyze that?
So to put this into context, essentially last year was a phenomenal year for us where we outperformed global markets, be it developing or developed, in a range of 10 to 20%, depending on the index you look at. And this is in US dollar terms. So with that in perspective, our valuations have gotten slightly expensive with regards to our regional peers. And so what that could translate into is we may have a sideways kind of a market for at least for the first half of this year, especially given the China reopening story. Now, this is where earnings season becomes all the more important, because I think a good earnings season and a good earnings outlook will ensure that our markets continue to remain attractive. Now, to your point on those basket of stocks, essentially, if you go back last year, essentially the stocks that did well last year were stocks with high beta and high volatility. History has shown us that that is not a sustainable trend, and we are already seeing cracks in that style performance so far this year. If anything, last year, the frontline styles, be it stocks with good quality, good growth, underperformed the broader markets, as a result of which they are now actually trading cheaper to their longer term averages. So I think they are actually better positioned to resume their outperformance to broader markets over the medium to longer run. And in that context, we are positioned that way, where we are looking at bottom-up opportunities, but with low beta and low volatility.
Karthik, the other important point was that up till now, last 3-4 years, Indian markets had very far superior earnings quality. But now we are seeing that other countries also will start showing earnings growth, and hence the valuation of those companies will start looking relatively attractive, 1 point. And the global growth, which is slightly on the lower side, may start impacting India's growth estimates for various corporates. Has the market adjusted to lower estimates on earnings or not yet?
The earnings have come down since the beginning of the year. So, however, having said that, we are still at the higher, we are still trading at a premium to our longer term averages. So there is a risk there that if earnings come off materially, then we may have to adjust. But having said that, as of now, there are no signs that we would have to we would have to take that into an active consideration. The budget is supportive of growth, and I think in the near term, at least, barring any external events, I don't think we have to be worried about it. But your point is relevant in the sense that global capital will now look at opportunities elsewhere which didn't exist a year back. We were the only shining star on the horizon. That is no longer the case.
Karthik, how do you see the valuations on which mid and small cap end of the basket is actually trading at versus their earning quality? Do you see their earnings are also at risk, and hence the valuation? Because they have traditionally, as in at least last couple of years, have commanded premium because of their higher growth.
So you're absolutely spot on. Mid caps and small caps are trading at a valuation premium to large caps. So which is why in this environment, probably large caps look better, given they are also better from a risk perspective. And which is where earnings season becomes all the more important, and the earnings outlook needs to be tracked keenly to ensure that you are in the right spaces across sectors or be it cap space.
Would it be a right approach to take 18 to 20 18 to 20 months kind of view, and could this period turn out to be a period for the markets for long-term investors to deploy capital, not really harvesting but sowing the seeds, because the time would be volatile, earnings will trough out, you'll get actually good price on a valuation on the lower side.
So I completely agree with you. One should look at a longer term horizon, but more so because some of the points I highlighted before, wherein the frontline styles have all underperformed last year. So what that has meant is like a portfolio of good quality stocks, portfolio of good momentum or growth stocks for that matter, are trading at a discount to the longer term averages. So it is actually a good, it may actually be a good entry point to kind of build your portfolio with a longer term horizon in mind. Keeping in mind that catching bottoms or catching tops are extremely difficult, if not impossible.
Which end of the market right now do you see very high quality growth on earnings even from here on? Because let's say, for example, banks, some people are saying earnings growth may happen, but the peak profitability may be hit this March quarter. So from here on, what will drive earnings?
So where we are positioned in that perspective is we are actually, we like autos, where essentially the companies across the space, be it four-wheelers, two-wheelers, commercials, they have reported good numbers, and also there is good growth visibility over the near-term horizon. By that, I mean over the next year, year and a half. So autos continue to look good. Consumer staples can also be a good sector to look at, especially given the fact that commodity prices have come off and they should benefit from improving margins. And also consumer staples being defensive in nature can help in markets like these. Lastly, we also like utilities because they have good valuation backstop, especially good dividend yields, and in a market like this, where it is quite volatile, the valuation backstop can really help kind of strengthen your overall portfolio.
All right, Karthik, we'll let you go on that one. Thanks so much for joining us on the show today.
Thanks.
That was Karthik Kumar of Axis Mutual Fund, talk about their market view.